Hello everyone. Hi, how are you people? All of you people who wrote your May 2022 CA intermediate examinations. How did your exam go? I hope it all went well, and I hope you venture into articleship and also go down to write finals very soon. In this video, I am bringing you the solutions in detail to May 2022 advanced accounting examination. Yes, and before I go any further ahead with this particular video discussing solutions, I have an announcement of an 100% English comprehensive batch for advanced accounting is starting on 1st of July on the platform of Unacademy from the team of Yashas Academy. You get to learn from Shandar Ahmed sir for economics, Dhananjay Bave sir for financial management, Murugesh Madlani sir will be teaching you EAS, strategic management from Mita Mangal ma'am, audit from Karthik Iyer sir, accounting stands from Ravikant Viryala sir, and advanced accounting other than AS part will be handled by me and Mayur Nata sir jointly. So the tentative schedule for the first few months, July and August month is here. The classes for the month of September, October will be informed to you people very soon. So hoping to see you all in the batch. And you can take up Unacademy's iconic subscription, which is the flagship model of Unacademy, which gives you way more added benefits than the Simple Plus program. In the Simple Plus program or in the Simple Plus subscription, you know the advantages. You get live interactive classes, recorded backup of all the classes available, which you can see at later stage, structured PDF and notes for all the sessions, live tests and quizzes, open houses, and then what to say, digital notes for everything, and one subscription giving you access to all the lectures of all the educators of an academy. That exists, but the iconic subscription will give you the benefits of one-to-one live mentorship, printed study material at your doorstep, exclusive doubt solving sessions, and lot more. So what are you waiting for? Take up your Unacademy subscription today by paying the cost of 62,000 for 24 months, 38,250 for 12 months, and 30,000 for 6 months. If in case you use the code YESHAS LIVE, which is YESHASLIVE, you will get 10% off on the price that you saw here now on the screen. So what are you waiting for? Take up this subscription and let us help you in this journey of CA intermediate, and let's learn a lot of things together. Yep. So that's with regard to the announcement of the new batch that we're starting. Now let's get back to our question paper. So this is the question paper of May 2022 examination, which we're just going to discuss in detail now. So this question paper can also be accessed by going from the ICA website. If you are unable to find it there, I will put the link to this Excel sheet in the description, which has solution to all the questions. So in this, I have also given the link to the May 2022 examination question paper. Clicking on this link will give you the question paper of May 2022 examination. Got it? Fantastic. So I've analyzed the paper at first, and I'm not solving the paper now live. I solved this paper yesterday, sitting back on my recliner, watching some songs, and then munching some chocolate chips and having a sip of milkshake. So I took about 4 hours to solve the entire paper, after considering the fact that I was not completely dedicated, not giving my 100% when I was solving it. Moreover, I solved the paper not for 100 marks but for 124 marks. That is the entire paper. And I would say, though the paper was little lengthy as usual, it was very much solvable. 100 marks 3 hours was very much in time and possible. People who would have done enough writing practice could have easily cracked the paper in 3 hours. However, there were a couple of questions which are little hatke and not expected types, but still, there was nothing so difficult that 100 marks was impossible. Yep, that's my interpretation of the paper. And question number one, as usual, was completely accounting standards. And other than question number one, there were a couple of other parts where accounting standard was mentioned. That is 6A, sub question 6, sorry, question number 6, sub question A, and question number 6, sub question C was again on accounting standards. So we can say entire question number 1, and in question number 6, 2 sub questions was for accounting standards. So accounting standard came for 20 plus 5 plus 5. So we can say 30 marks was from accounting standards, and the rest of the marks came from other chapters. We had one big question of 20 marks from amalgamation this time, and one big question of 15 marks from consolidation. So amalgamation, consolidation came up to 35 marks, and banking was a little lower this time. Banking came for one 5 marks question on NPA, which included a theory question, and financial statement question came for 10. Oh, no. Banking was also good enough. 15 marks is very nice from the chapter of banking again. And partnership had one 15 marks question on dissolution of firms, and one more 5 marker was a theory question on LLP. So again, partnership came for 20 marks in this paper, buy back an easy 10 marker on using the equation to identify what is the maximum permissible buyback. One very easy question, which similar question was there in the previous attempt also, that is computation of differential voting rights when there are preferential holders as well as equal holders. Very easy to do question. I've done the solution. I'll share it with you. Very easy. 5 minutes. Sorry, 5 marks question of this sort can be solved in 2 minutes or lesser. So this was a lottery question, and we had another question from liquidator's final statement of accounts. So that's about 5 marks, and another 5 mark is even from ESOP. So that was the pattern at which this paper came in. There were a few chapters which were left out without coming into the examination. There was no question from internal reconstruction. There was no question from NBFC, and yeah, a couple of other chapters did get left out, and then questions didn't come. However, let's start, shall we? The paper code is FPR. I've done all the solutions with detail and notes. Yeah, the paper code is FPR. As usual, question number 1 is compulsory, and there are 6 questions, 20 marks each, 120 marks. Last question has an internal choice. So first question is mandatory. Out of the next 5 questions, we need to answer only 4 of them. So 4 20s are 80, and first question 20 together comes to 100 maximum possible marks which we can score. So let's start with the first one. First question is TQ Cycles Limited is in manufacturing of bicycles, a labor-intensive manufacturing sector. Fantastic. In April 2022, government enhanced the minimum wages payable to workers, because of which the company is now forced to pay higher wages than it was paying before. Now, a very important thing that should spike up the moment you read this is, this question is on AS4 or AS5 types. You get what I'm trying to? There is events occurring after balance sheet date or profit or loss for the period, and what is the effects of changes in foreign exchange? Effects of changes in accounting policy. Changes in accounting policies. Done. So government enhanced the minimum wages, retrospective effect, not from the date the order came, even for the period before such order, they are supposed to pay higher wages now. Very good. That is effective from 1st of January 2022, but the order came on 1st of April. So for the first 3 months also, we are supposed to pay additional wages. Due to this legislative change, the additional wages for the period January 2022 to March 2022 amounted to 30 lakhs. They are paying additional wages. Management asked the finance manager to charge these as prior period items. Can these be charged as prior period item? The answer is no. You cannot charge this as prior period item. What exactly is a prior period item as per ES5? An item will be considered as a prior period item if it is arising in the current period because of an error or omission in the previous period. In this context, the previous period is 21-22. That is 1st of April 2021 to 31st of March 2022. And the current period is 1st of April 2022 to 31st of March 2023. Last year, January, February, March, we have paid wages according to the limit. This year, in the beginning April, government has retrospectively changed the minimum wages, because of which I need to pay some additional compensation to the 3 months of last year. If I have to pay additional compensation to 3 months of last year, that is January, February, March, I can't provide it in the previous year because I got to know this year that I need to pay extra for last year. In the current year, when I provide for the same, can I call it a prior period item? I could have been calling it a prior period item if I was supposed to pay wages in the last year. I forgot to provide for it in the last year as an error of omission or commission. But this does not arise because of an error or omission in the previous year. Previous year, I have correctly recorded it. Now, additional wages is to be paid for previous year exclusively because the regulation or the legislation by the government has changed for minimum wage. So, such outstanding amount or such additional amount for the last 3 months of previous year payable in the current year to be provided for in the current year is not a prior period item, as it is arising because of a legislative change and not because of a error or omission in the previous year. You get this? So let's see the first part of the answer. Have a look. Prior period item is an item arising in the current year as a result of error or omission in the previous year. In the present case, additional wages payable is due to change in the legislature and not an error. So management's decision of treating it as a prior period item is incorrect. Got it? Very good. So then let's go to the next part. This we are done till here. Further, the finance manager is of the view that this amount being abnormal should be disclosed as extraordinary. What do you mean by extraordinary? Extraordinary item refers to such items which is not in the ordinary course of operation. Paying wages, buying goods, selling goods, paying all other kuti expenses, receiving all these small incomes. All of these are in the ordinary course of operations. though there is a what do you say retrospective change because of which you are supposed to pay additional wages, what you pay is still wages. Whom you pay is still the laborers. What you get from is still part of your operating activities as a benefit. So this statement again, what is given here, stating that it is an extraordinary item, is wrong. It is again wrong. It cannot be considered as an extraordinary item. This payment of wages, irrespective of the fact that it is increased because of retrospective change in the legislature, is still in the ordinary course of operations and cannot be regarded as extraordinary item. See this part? Further, wages payable is as a part of ordinary course, cannot be considered as extraordinary. So, finance manager view of treating it extraordinary is incorrect. Done. However, based upon the nature, timing, extent, size of the operations, amount involved in the transaction, it can be considered or disclosed separately as it is considered to be an exceptional item as per AS5. That is possible. So, what is the only thing that they can do? They can disclose it separately as an exceptional item, considering its timing, extent, and amount involved, and all nature, timing, and extent, as you mentioned in audit. So, based on those things, you can consider it as an exceptional item. Have a look. However, considering the nature of transactions, its incidence and amount involved or size, it can be considered as an exceptional item and disclosed separately as AS5. So that, my friends, is the answer for the first one, and it is easy to answer even before completing the rest of the question. However, formality sake, let's read the rest of the question. Yep. Then the question goes like, further the finance manager is of the view extraordinary. That's it. They've asked discuss with reference to applicable accounting standard. Reference is to AS5, and the answer is it is not extraordinary. It is not a period item, but can be disclosed as an exceptional item, considering the nature and incidence involved. That's the solution to question number 1A. I'll show it to you for a second if you want to take a screenshot. However, I'll share the complete Excel sheet with you people. I hope you guys understood this part. Chalo. Let's now go to the second part. Question number 1B. This is again a 5 marker. NAT, a listed entity, as on 1st April 2021, had the following capital structure. There are two variants of capital. One is equity shares, other one is preference shares. During the year 2021-22, company had profit after tax of rupees 90 lakh. Very good. This is the amount available to shareholders. First preference dividend, then equity dividend. On 1st of January 2022, company made a bonus issue of 1 equity share for every 2 shares. So we issued 1 equity share for every 2 shares. In the past, we've had 10 lakh equity shares. So when you issue 1 equity share as bonus for 2 equity shares held, the freshly issued equity shares will become 5 lakh. How? 10 lakh is to how much? Is 2 is to 1. So for every 2 shares, you get 1 share. So for 10 lakh shares, you get 5 lakh shares as bonus. You are issued 5 lakh shares as bonus. So after bonus, total number of shares will become 15. And this question is on earnings per share computation, EPS. There are two important things that you need to note. Number one, whenever bonus issue is made, only number of shares will increase. There is no inflow of cash. You don't receive any money. Why? The reason being, bonus issue is capitalization of reserves, and it is not issue of shares for a consideration like cash. So profit on the top will remain the same. Number of shares in the denominator will change, definitely after making preference dividend, and that's how we compute the earnings per share for earnings per share after bonus issue. The important point here is whenever bonus issue is made, you compute that for entire year, irrespective of the fact whether bonus issues happen at the middle of the year, end of the year, or the beginning of the year. Because there is no inflow, as I mentioned, it wouldn't really matter. So we do it for the entire period. So when you take weighted average or something, don't do for period. Bonus issue, take it for entire period. However, if it was any fresh issue, we would have taken it from the date of issue till the year end. That proportionate period we would have considered for computing weighted average number of shares. Because bonus issue doesn't lead to change in the equity or the net worth of the company, only the capitalizing of reserves is happening. What we need to do is we need to recompute our or restate our earnings per share of the previous period, considering what if the bonus issue was made previous year. You get this? So previous year's earnings per share should be restated whenever bonus issue happens in the current period. So if you can remember this, the rest of the answer is very simple. Yeah. So let's read the remaining part of the question. We've read till here bonus issue. The next part is on 1st of January, NAT issued 2 lakh equity shares at rupees 1 each. Okay. At their full market price of 7.6 per share. So they are issuing 2 lakh new equity shares. Definitely there is no bonus on this. This is shares issued for cash. These are issued this date only along with bonus issue. For these 2 lakh shares, we are going to compute proportionate period. Do you get this? So what date are they issued? They are issued on 1st of January. Very good. So we will recompute that weighted average number of shares. Taking this 2 lakh equity shares for a period of 3 by 12. Why? It is issued only on 1st of January. So it will be in the organization for January, February, March. It is not there before Jan. So we need to recompute the number of shares in the denominator. That is the weighted average number of shares. Very good. NAT's shares were trading at 8.05 per share on 31st of March 2022. Further, it has been provided that basic earnings per share previously reported is 62.3. Why have they given this? This 62.3 is given so that once we find the number of shares, once we find our current year EPS, we need to take this 10 lakh shares multiplied by the 62.3 to identify the earnings available to equity shareholders in the previous period and divide that not just with this 10 lakh but 10 lakh plus 5 lakh, that is including bonus issue value in the denominator, so that we can identify the restated earnings per share. Yeah, so let's see the solution. The solution goes like this. Okay, what have they asked? They've asked us to compute, at first they've asked us to compute basic earnings per share for year ended 31st of March 2022. Very good. Then they've explained why bonus issue shares um, and the shares issued at full market price are treated differently. Obviously, like I just mentioned, fresh issue of shares at market price will lead to inflow of cash and change in net worth. However, when the shares are issued by way of bonus, it is capitalization of reserves and will not lead to any inflow. Fresh issue made for cash, proportionate period of outstanding shares outstanding in the company will be considered in weighted average computation. Bonus issue will take it for the entire year and in fact restate the previous year figures also. That's our answer. Let's see. The profit after tax, as it was mentioned in the question, is 90 lakh, and from that we'll deduct our preference dividend. Preference dividend is 1 crore rupees into 8%. So how much is 1 crore into 8%? 8 lakh. After paying 8 lakhs of preference dividend, we get 82 lakh as the amount available to equity shareholders. Now this will be divided by weighted average number of shares. We don't know weighted average. We need to compute. That brings us to working note number 1. So opening equity shares is 10 lakh shares which are there for entire year. Then bonus issue 10 lakh into 1 by 2 because one bonus share for 2 shares. So 5 lakh, this also is computed for entire year. However, the fresh issue of 2 lakh shares that's been made will be considered only for 3 months, January, February, March. So you do 2 lakh into 3 by 12, that gives you 50,000. So 10 lakh plus 5 lakh plus 50. 15 lakh 50,000 is the weighted average number of shares. So we'll go ahead, divide our 82 lakh profit available to equity shareholders by 15 lakh 50,000, that is weighted average number of shares. That's how we'll arrive at earnings per share of 5 rupees 29 paisa. This is for the current year. Now we need to restate our previous year's EPS. I just mentioned to you that we have discussed 5.29, we have disclosed 5.29 here. Previous years, they mentioned it is 62.3. 62.3 is the earnings per share for how many shares? 10 lakh. If we multiply 10 lakh shares into 62.3, we'll get the profit for the previous year divided by the restated number of shares. That is, if bonus issue was made in the previous year, that is 10 lakh plus 5 lakh. 15 lakh is what we'll take in the denominator. So if we do 10 lakh into 62.3 divided by 10 lakh plus 5 lakh, the restated earnings per share for the previous year, only for the sake of comparing with this 5.29, is 41.53. Understood, everyone? So now we've actually restated the EPS for the previous year also. And that's with our solution for the first part of question number 1B. Question number 1B2, second part, was about why is bonus issue treated differently from shares issued for a consideration at market price. So here is the answer. Have a look. Bonus issue and shares issued for consideration are treated differently. The reason being, bonus issued is capitalization of reserves. There is no consideration received and there is no change in the net worth. However, on the other hand, whenever shares are issued for consideration like cash, it will result in change of net worth of the company. That's what I had mentioned to you then. That's what I'm giving reference to you all again. Yeah. Shall we now go to 1C? Yes, let's go to question number 1C. Here we go. Question number 1C on your screen now. Alloy Fabrication Limited is engaged in manufacturing of iron and steel rods. Fantastic. The company is in process of finalization of its accounts for the year ended 31st of March 2022 and needs your advice on following issues in line with AS 29. So this is basically on provisions, contingent liabilities and contingencies. Let's read. On 1st of April 2019, company installed a huge furnace in their plant. The furnace has a lining that needs to be replaced every 5 years for technical reasons. So for technical reasons, it has to be changed. There is no mandatory condition that it has to be changed. So it is like you say in costing, it is their decision whether to repair it or replace it. But they're doing it for some technical reason. Okay. At the balance sheet date on 31st of March 2022, company does not provide any provision for replacement for lining of this furnace. Now, firstly, let's write the definition of provision and then write the other things. Provision is a present obligation arising because of a past event. It's basically a contingent liability which fulfills two conditions. Number one, probable outflow. Number two, reliable estimate. If I have to tell you the definition of provision, I would tell it's a present obligation arising from one or more past events which results in probable outflow and the reliable estimate of that can be made. You get what I'm trying to tell? Yeah. So this particular furnace, they have not made any provision. Is it mandatory to do provision? No provision is required because there is no obligation. There is no condition like you have to change it after 5 years. No. Because of technical reasons, you are preferring to change. So the answer would be pretty simple. First, define what is provision. Then say that the change of furnace will not lead to creation of provision because there is no obligation to create, obligation to change that furnace. But they do it for technical reasons only. Done. So let's go to the next part. The next part, that is the second part, is a case has been filed against the company in the consumer court and the notice for levy of penalty of 50 lakhs has been received. Yeah. So there is an event which is going to happen in the future which is uncertain and uncontrollable and that might result in outflow of resources to me. So this is a contingent liability. What is this? A contingent liability. To start the answer, we'll read the definition of contingent liability. As per Accounting Standard 29, contingent liability is a obligation. It's a possible obligation. Liability is an obligation. Contingent liability is a possible obligations whose existence is confirmed by occurrence or non-occurrence of one or more future events. You get this? Now here, that consumer court there is a case pending. That judgment of that case is future. It is uncertain and it is uncontrollable. And based on that occurrence or non-occurrence, means occurrence of case going in my favor, case not going in my favor, there is a possibility of outflow. There is a possible obligation, not a present obligation. Such possible obligation is dependent on occurrence or non-occurrence, or which is confirmed on occurrence or non-occurrence of one or more future uncertain uncontrollable events is a contingent liability. Very good. So 50 lakhs has been received. The penalty might be 50 lakhs if the case goes against us. The company has appointed a lawyer to defend this case for a fee of rupees 5 lakhs. Okay. 60% of the fees has been paid in advance and the rest 40% will be paid after finalization of the case. So we can record it later or you would have to pay him in spite of the fact whether we win the case or not. In such a case, we can actually provide for that balance fees. For the balance lawyer fees payable, we can make the provision. Why? Whether we win the case or we lose the case, we might have to pay that fee to lawyer. Okay. There are 70% chances that the penalty may not be levied. So the case will go in our favor. 70% the case will go in our favor. So that possible obligation is less. That obligation becoming possible is very less. It's very, very less. So because of it, there is no provision required. We will just disclose it as a contingent liability in the footnote to balance sheet. See the answer. AS 29 provisions, contingent liabilities and contingent assets. What does it say? Like I was mentioning, contingent liability is a possible obligation arising from past events whose existence is confirmed on occurrence or non-occurrence of one or more future events. One or more uncertain, uncontrollable events. Very good. In the present case, outflow of arising by way of penalty is only 30%. 70% the case is in our favor. So, which is a possible obligation and we would wait for the court judgment. So we will disclose it as contingent liability and provision and all not required. The third part is further fee already paid 3 lakhs is to be shown as expense. Prepaid expense also you can write in the balance sheet. And as a possibility of unfavorable outcome resulting in outflow of cash is necessary. Oh, sorry, there is no need to create provision against it. So, there is no need to create provision for the amount payable as penalty. But for the lawyer fee, you can create the provision for the balance amount because that balance amount need to be paid irrespective whether we win the case or not. Done? So that's with regard to 1C. I think we're all set to go to question number 1D now. Shall we? Yes, guys, question number 1D on your screens now. Yeah, Grace Limited. Ouch. Sorry. Yeah, it's a firm of contractors. So this question is on accounting standard 7, construction contracts. Provided the following information in respect of a contract for the year ended. So they've given the fixed contract price with an escalation clause, meaning this price is fixed, but it can be escalated when the clause is triggered, whatever is it, or the circumstances given in the contract gets triggered. So then the contract price will increase, can be increased. Very good. Work certified, meaning the work that is completed and approved is 17,500. Okay, work not certified is 3,850. Okay, this much of work we have completed, but they have not yet approved the same. And then is estimated cost of completion. After this, the further expense that we need to incur to complete the project is 17,325. Using these three items together, we can find the percentage of completion, PCM. Why do we compute percentage of completion? Percentage of completion is the basis to decide how much revenue to be recognized in the current year. You get this? So much percentage of our contract revenue will be booked in the current year and expense incurred will be booked. Difference will become contract profit. Yeah? I hope you guys understand. Then progress payments received 14,000. We can also compute if there is excess payment received or there is any amount further receivable from the client. That can also be computed. Once you arrive at PCM and identify contract revenue. Next, payment to be received 4,900 yet to be received. Okay. Escalation clause 8% and accordingly the contract price is increased by 8%. So it is triggered and we will get 8% extra revenue. So when we consider the contract revenue, you should take 8% more than this 35,000 only straight away. Yeah, they've asked us to compute the contract revenue. Very good. And calculate profit or loss for the year ended. And is there any provision to be made? When do we make provision? So provision is made like this. So I told you work certified plus work uncertified plus expense to be incurred is the total cost of the project. On the numerator, we'll take work certified plus uncertified. So extent completed divided by total cost of the project will give us the percentage to the extent which the contract is complete. Such percentage will be applied on the contract revenue. Definitely after providing for such escalation clause. That will become our contract revenue. Contract expense is available in actual basis. So revenue and expense when we adjust, we arrive at profit. You get this? This is what we should recognize as income. However, if it is a case where total cost of the contract, if it exceeds the contract revenue, that is expense incurred plus expense expected to be incurred to complete the project. Those together, they form the total contract cost. If the total contract cost exceeds the total revenue, then we need to book the entire amount of loss immediately. Normal, prudence, conservatism. You need to provide for, you need to book entire loss. To the extent it is completed, you will book it as loss. For the remaining amount, we would have to make provision. Yeah, sir, but the project is not complete. How can I book the entire loss? We need to book the entire loss. Why? Conservatism. Expected expenses and losses should be provided for. You get this? And this entire loss arising because of contract revenue being lesser than total contract cost should be booked irrespective of percentage of completion, irrespective of profit to be earned from the upcoming projects or any other reason. So it should be always booked. Got it, guys? Hello, let's see the solution. Original contract revenue is 35,000. It's here. Have a look. Now we are going to add escalation clause of 8%. When I add escalation clause of 8%, total contract revenue revised or new contract revenue after considering escalation clause becomes 37,800. On this, we'll apply percentage of completion to arrive at contract revenue to be recognized. But we need to compute the contract revenue, percentage of completion. Let's go ahead, compute percentage of completion. Work certified is 17,500. Work not certified is 3,815. And here in the bracket, they've given information that to the extent of 1,40,000, the material is unused. So here it is 1000. So here we can take it as 140. So to the extent of 140, I deduct from the work not certified. So work not certified comes to 3675. If I take 17500 plus 3675, I'll arrive at total work completed, which comes to 21175. This is the extent to which work is completed, and they were given us estimated cost for completing the project 17320. Why? If I add that, I'll get the total cost of the project. Total cost is 38,000 and the work completed is 21,175. So if I do 21,175 divided by 38,500, I'll immediately arrive at percentage of completion, which is 55%. Am I right? We will immediately arrive at the percentage of completion, which is 55%. So 55% of the project is complete. Now we will apply this 55% on this contract cost of 38,500. If we apply that, sorry, yeah, if you apply that 55%, oh, sorry, here. On this contract revenue of 37,800, I'll apply 55%. So contract revenue to be recognized comes to 20,790. Yeah. Okay. Then profit and loss. Just now we just discussed contract revenue recognized is 2790. Expense incurred till date comes to 21,175. That is work certified plus work uncertified minus the stock left unused. So I'll arrive at profit for the current year as minus 385. There is loss. There is loss. So what do we do? Contract revenue. Now compare if there is total may loss. Contract revenue is 37,800 in the total, and contract cost in total is 38,500. We will just compute it. So even if we complete this project, we'll end up paying extra money. There's going to be loss. How much is the loss? That's going to be 700 rupees total estimated loss. But loss to be recognized in the current period is 385. Am I right? Loss relating to current period is 385, but total loss from the project is 700. So what do we do with the balance amount of 315? Will I record it in next year? No, I'll provide for such loss in the current year only by way of provision. Do you get this? Why? Simple conservatism principle. So I created provision for 315. 385 is the loss to be recognized in the current year in the contract period. Got it, guys? So by this, I've successfully finished the next question also. Shall we go to the next one? We're done with 1D, and we can say we finished 20 marks of our paper. 20 marks, khatam. Okay, first question, 20 marks, accounting standards. Done. Let's now go to question number 2. Question number 2 on your screens now. The following is the summarized balance sheet of A Limited and B Limited as the 31st of March 2022 is as under. Quickly come to the last line, see what do they want. So this is an amalgamation question. Come to the last line. Assuming amalgamation in the nature of purchase. Okay. You are required to pass journal entries. Okay. Narration not required. So they mentioned narration is not required, so we don't have to write. In the books of Z Limited and prepare balance sheet of Z Limited after amalgamation. Shall we start with the solution? Everyone? Chalo. Let's read the little beginning part. Balance sheet will be there. Let it be there. We'll read the adjustments and then start seeing the entries. So authorized capital of Z Limited is 60 lakhs and divided into 6 lakh shares of rupees 10 each. Okay. Registered value and the value of equity shares 18 per share and 12 per share. This is the exchange ratio. Then 10% debentures of A Limited to be issued, 12% debentures of Z Limited. This is settlement of consideration to the debenture holders of the old company. Because they have debentures of the old company, once we acquire the old company, those debentures have no validity. So against that, we are giving them something new. That is 12% debentures in the new company. There is a contingent liability of 2 lakh in the previous balance sheet. It is to be considered as actual liability because maybe it's no more a possible obligation, but it is an obligation now. Got it? And then there is liquidation expenses and registered value or fees of A Limited. Wow. Okay. This is the expense of the transferor paid by the transferee. So this will be treated as goodwill. What is it? 2 expenses. One liquidation expense of 50 and registered value or fees of 36,000, which belongs to A Limited, should have been paid by A Limited, but now paid by Z Limited. Okay. Fantastic. Lastly, the shareholders of A Limited and B Limited is to be paid by issue of sufficient number of fully paid up equity shares of rupees 10 each at a premium of 10 per share. Okay. So shall we start with accounting entries in the books of Z Limited? Z Limited mein entry number 1. will be for purchase of the business. So we will write business purchase account debit for acquisition of the business of A Limited and B Limited. You have to settle the consideration to liquidators of A Limited and liquidators of B Limited. So that's the reason, my friends, you write the entry business purchase account debit to liquidators of A to liquidators of B. Now, how much amount should you write there? How much amount should you be writing there? You should be debiting business, or say their purchase consideration there. So purchase consideration, one second. Whatever is payable is to be debited. Have they given the purchase consideration amount here? Okay, it's not really given, but we know the exchange ratio, correct or not? So 18 per share and 12 per share, the value per share of A Limited and B Limited. So A Limited, how many shares are there? 30 lakh. It comes to 3 lakh. So have a look. So this is 3 lakh shares multiplied by 18. So I'll write this for you. So 30 lakh is the equity capital of A Limited of rupees 10 each. So that is 3 lakh shares. Multiplied by what is the agreed value? Agreed value is 18 for A and 12 for B. So I'll do into 18 per share. Yes, 3 lakh into 18 is 54 lakh. And for B Limited, agreed value or registered value is 12, and number of shares is 24 lakh rupees, 10 rupees per share. So it is 2 lakh 40,000. What is it? 2 lakh 40,000 multiplied by 12 per share. That comes to 28 lakh 80. And if you add this 54 lakh and 28 lakh 80, it is 82 lakh 80,000. You get this? Maybe when I was writing this 54 lakh and 28 lakh 80,000, I was watching Pushpaka song. When I was doing this Chukega and I forgot to type this working note 3 lakh into 18 and 2 lakh 40,000 into 12. So I added it up. However, you people will not go even a step down. I know. Chukega nahi na. So that's the reason I have given that working note in detail, so that you will not have a doubt when you see this or refer this file at a later date. That's it. So this is purchase consideration due. Now we need to open this box, business purchase. So business purchase account will be credited, and the debit will be given to all the assets and liabilities. So assets and liabilities, we'll start with assets. We'll take 28 lakh plus 21 lakhs. Here 28 plus 21, 49 lakh. Land and building. Plant and machinery, 20 lakh plus 7 lakh 60. Here 20 lakh plus 7 lakh 60, 27 lakh 60,000 plant and machinery account debit. These assets are taken over by Z Limited now. Then long term loan of B Limited, 2 lakh 20. So 2 lakh 20,000 long term loan of B Limited taken over. Yeah. Inventory taken over 10 lakh 40 and 7 lakh, 17 lakh 40,000. 10 lakh 40 and 7 lakh, 17 lakh 40,000. Then trade receivables taken over 8 lakh 20 and 5 lakh 20. Together it comes to 13 lakh 40. So here 8 lakh 20 and 5 lakh 40, 13 lakh 40,000 trade receivables taken over. Then we have cash at bank 3 lakh and then 3 lakh, 6 lakh rupees taken over. So I'll write 3 lakh plus 3 lakh. Oh, there is some adjustment, I guess. Dividend. We didn't read now. B Limited has issued dividend 1 per share. So how many shares are there? It has 2 lakh 40,000 shares. So 2 lakh 40,000 will be paid. So in the cash, 3 lakh will come from B Limited. From B Limited's cash of 3 lakh, 2 lakh 40,000 is distributed as dividend. Only 60,000 is remaining. So we'll take 3 lakh plus 60, 3 lakh 60. Here 3 lakh plus 3 lakh minus 2 lakh 40, 3 lakh 60. That is the amount available. Now let's go for liabilities. What liabilities? Liabilities start from the bottom. Okay, don't start from the top, because lot of items from the top are not coming. So trade payables 1 lakh and then 3 lakh 40. Let's take trade payables 1 lakh plus 3 lakh 40, 4 lakh 40. Got it? Then we'll take unsecured loans from B Limited 6 lakh and 8 lakh 20. That is 14 lakh 20,000. 14 lakh 20, 6 lakh and 8 lakh 20. Unsecured loans taken. Then we have 10% debentures taken over 20 lakh. I'll write that as well. 20 lakh 10% debentures taken over. After that we have retirement gratuity fund 1 lakh. That retirement gratuity fund 1 lakh only in one company. Then we have other liabilities. Other liabilities is not here. Okay. Maybe the other liability is with regard to something else in the adjustment. So we have done with this so far. This we did. It is a contingent liability to be treated as actual liability. So that's a liability taken over, which is to the extent of 2 lakh. So we'll credit that also to the extent of 2 lakh. If you do this, I will also debit my, credit the business purchase which I previously debited 82 lakh 80. If I do that, whatever balance and figure I get is goodwill. That is the excess consideration paid. Amount PC to the extent it is greater than net assets taken over. That's what we are just arrived at. That's what we just arrived at now. Got it, everyone? Okay. This is the entry for decoding business purchase. So once we write business purchase to liquidators, we'll write assets debit, liabilities credit, business purchase credit. Balance and figure will go to goodwill. If it was credit, it would have been capital reserve. Now we will settle this liability, that is purchase concession, to liquidators. So we'll write liquidators of A limited debit, liquidators of B limited debit, and then give them what they belong, give them what they should get. So what should we give them? Should give them equity shares. Should give them equity shares. We've been told that equity shares are to be given at 10 rupees premium. Am I right? Somewhere was there. It was there somewhere. Shareholders of A limited and B limited to be paid by issue of sufficient number of equity shares of rupees 10 each at a premium of 10. So 10 rupees nominal value, 10 rupees premium. Issue price is 20. Issue price is 20. So what should we do? We should basically do 54 lakh plus 28 lakh 80 divided by 20. Divided by 20. That will give us number of shares to be issued. Those number of shares we multiply by 10 here, multiply by 10. I'll show it to you. 54 lakh plus 28 lakh 80,000. So this is the total value of shares to be issued. Sorry, total value of PC. Am I right? This will divide by 20 rupees per share. What do we get? 28 lakh 80,000 divided by 20. We get 4 lakh 14,000 shares. 4 lakh 14,000 shares multiplied by 10 per share. This is nominal value, and same 4 lakh 14,000 shares multiplied by 10 per share is premium. Here I can write if you want. That will come to 4 lakh 14,000 shares, and we'll issue 4 lakh 14,000 shares at 10 rupees nominal value and 10 rupees premium. Yeah, that will become 41 lakh 40,000, 41 lakh 40,000. Now, for the old debenture holders, we're giving new debentures. It is not at premium or discount or anything. So 10% debentures of A limited debit to 12% debentures. This 10% debentures of A limited is what we have credited here, which will get closed. And in the new balance sheet, we'll write this new 12% debentures. Got it? Then we need to write the entry for that valuer fees and liquidation expenses paid. How much is that? That is, where was it? Where was it? 50,000 plus 30,000, totally 80. So 50 plus 30, 80,000 will be recorded as goodwill account debit, bank account. Khatam. Then the last one, that unsecured loan is there, no? Yeah, that represents a long-term loan from me, mutual indebtedness. We'll write it off. So in the previous balance sheet, there was one liability here, there was one asset here. They both are connected. This is same as this. To one it's asset, to one it's a liability. It is okay till the time they've been treated as two different persons, but they become one person when we amalgamate and prepare balance sheet. The amalgamated balance sheet in the books of Z Limited, that should not come. So we eliminate that 2,20,000 from both places. So liability decreasing debit, asset decreasing credit. That's it. We are done with entries. Now we have to write accounting entries. So sorry, balance sheet. So balance sheet is here. Schedules have been prepared in detail. I have not skipped a single schedule. I have not skipped a single disclosure requirement. So the first and foremost one is share capital. Share capital, what do we have? We have this newly issued shares. 41 lakh 40,000 rupees. That is 4 lakh 14,000 shares of rupees 10 each. So I have written the same thing. See, 41 lakh 40. I have done a working note, notes to account also. I have written authorized capital, that is 60 lakh, 6 lakh shares of rupees 10 each, and issued 4 lakh 14,000 shares of rupees 10 each. 41 lakh 40. As these shares have been issued for a consideration other than cash, requirement under schedule 3 as well as for the purpose of audit is that we need to disclose that certain number of shares or whatever is there is issued for consideration other than cash. Your entire 4,14,000 is issued for a consideration other than cash. I have disclosed the same. Got it, everyone? Then we have reserves and surplus, 41 lakh 40. We'll write that also. That's again security premium on issue of these shares. See, this security premium. There is no capital reserve or any other reserve arising. So I've written that 41 lakh 40 here. So 41 lakh 40 of share capital, 41 lakh 40 of reserves and surplus. I've posted to balance sheet simultaneously. Got it? Then we have long-term borrowings, 20 lakh. This is a new debentures issued to the debenture holders of the old company, 20 lakh. That is there in the journal entry. Then we have other non-current liability, 13 lakh. So this other non-current liability is this unsecured loan after adjusting for that mutual indebtedness, 2 lakh 20. And retirement gratuity fund is also payable at a later stage when the employee retires. So that is also considered as an other non-current liability. So if you put them together, we'll get 13 lakh. I've posted 13 lakh to balance sheet. Yeah. Then you have trade payables and other current liabilities. Trade payables, there is no need. Whatever is there, total I put the same amount. See in the journal entry what you wrote here. Trade payables is 4 lakh 40. I have written 4 lakh 40. Got it? So then other current liability is 2 lakh rupees. That is there. That is there. See other current liability. That contingent liability turned into liability. 2 lakh. I have written the same 2 lakh here also. Got it, everyone? Then the next part will now go to the asset side. On the asset side, what do we have? We'll write all of these assets. What we have: land and building, plant and machinery, and then long-term loans and advances, inventory, trade receivables, and cash. But land and building and plant and machinery will appear in PPE. Long-term loans and advances will appear as a non-current loans and advance. Inventory in inventories, trade receivables in trade receivables, current assets category, and cash and bank in cash and cash equivalent. So, chalo, quickly have a look. That's what I've done. Non-current assets PPE in property, plant and equipment. I've disclosed land and building and plant and machinery, 49 lakh and 27 lakh 60. And there is goodwill arising. Goodwill arising. One, because PC is greater than NATO. Next, because you paid that realization expense and valuer expenses. You add them that 80,000 and 11 lakh 20 what you paid extra. See, in the journal entries, we have both 11 lakh 20 as well as 80. See, 11 lakh 20 comes here because PC is greater than NATO. And we have additional 80,000 here because we paid the realization expense. So you add both 11 lakh 20 and then 80. That's how you basically arrive at this value of rupees 12 lakh rupees. That also I've added. Yep. And we'll post the other items straight to balance sheet. That inventory, trade receivables, cash and cash equivalent. If I post, then my balance sheet will tally at 1 crore 22 lakh 20,000. And this, my friends, is solution to illustration number 2 or question number 2. I hope all of you got this. So I would like to end this video in this part, and I'll come about to the next part wherein we'll discuss question number 3 and 4, and in part 3 we'll be discussing question number 5 and question number 6, and that will be end of our entire discussion in detail with regard to CA Intermediate Advanced Accounting May 2022 paper. I hope you all enjoyed, and just follow the same YouTube channel for the next video, part 2 video on the detailed solution to May 2022 Advanced Accounting paper. Got it? Till then, remember, life is not a battle to be struggling. It's a game to be enjoyed. I hope you guys are enjoying it, learning something new and having fun. Yeah. So till the time you're learning something new or having fun, it's all good. The day you guys either stop learning something new or stop having fun, trust me, you might start struggling because you might be in a battle. So the thumb rule to stay happy is pretty simple. It is to stay in the game. So for one last time on this day, I have just one simple question to all of you people. Are we in the game? I hope that the answer is yes, we are in the game. See you in the next video wherein I'll discuss question number 3 and 4. That is including one consolidation question and consolidation question and the question on financial statements of banking company. Yes, till then, tata bye bye, take care.